Let me be direct with you right now, because nobody else on this platform has the guts to say what I am about to say to your face. The financial system that has kept your dollar valuable, that has funded your government's deficits, that has made American stocks the envy of the entire world for the last 50 years, that system is ending. Not maybe ending, not theoretically ending, ending right now. As you sit there watching this video with whatever savings you have managed to scrape together over the last decade or two of your working life, a 50-year monetary architecture is being dismantled brick by brick, and the overwhelming majority of Americans, including, I will wager, you have absolutely no idea it is happening or what it means for the money you think you have. I have spent decades in the markets. I have taken on entire corporations. I have sat across the table from CEOs who thought they were untouchable, and I have made them accountable with nothing but capital and conviction. And I am telling you right now, with every ounce of that conviction, that what is coming for unprepared investors is not a correction. It is not a dip you buy. It is a generational wealth destruction event for those who do not understand what is happening, and a generational wealth creation event for those who do. The only question that matters today is which side of that line you are going to stand on. That choice starts right here, right now, in the next 25 minutes. If you are not subscribed to this channel, you are making a financial error that is costing you real money right now. The institutional analysis I am giving you on this channel, the macro frameworks, the sector positioning, the capital flow intelligence, this is the kind of thinking that hedge funds pay analysts hundreds of thousands of dollars a year to produce. You are getting it here for free. The subscription costs you nothing. The ignorance of not subscribing costs you everything. Hit the button, turn on notifications, because what I am covering in this series is going to be the most important financial education of your adult life, and you cannot afford to miss a single installment of it. Let me take you back to 1974, because this is where the story of your financial vulnerability actually begins. And I want you to understand every single word of it with absolute clarity. In 1974, following the Nixon shock of 1971, when the United States unilaterally tore up the Bretton Woods Agreement and took the dollar off the gold standard, the U.S. needed a new mechanism to create global demand for its currency. Without gold backing, the dollar was just paper. So Henry Kissinger flew to Riyadh, sat down with the Saudi royal family, and cut one of the most consequential deals in modern financial history. The arrangement was elegant in its brutality. Saudi Arabia would agree to sell its oil exclusively in U.S. dollars, and in exchange, the United States would provide military protection to the Saudi regime. That is the petrodollar system, and it is the reason that for the last 50 years, every nation on earth that needed energy, which is every nation on earth, full stop, needed to first acquire U.S. dollars to purchase that energy. Now think about the downstream consequence of that arrangement, because this is where your 401 kilobits enters the picture. If every country in the world needs dollars to buy oil, then every country in the world needs to hold dollars in reserve. And you do not hold dollars as cash sitting in a vault, because cash does not pay you anything. You hold dollars by purchasing U.S. government treasury bonds, which are essentially loans to the U.S. government that pay you a modest interest rate. What this created was an artificial, structural, globally mandated demand for U.S. government debt that had absolutely nothing to do with the actual creditworthiness of the United States government. Countries were not buying U.S. treasuries because they thought America was a great credit risk. They were buying them because they needed the dollars to function in the global oil market. And treasuries were the most efficient way to hold those dollars. The result was that the United States government could run deficit after deficit after deficit, spending trillions more than it collected in taxes, and the world would absorb that debt because they had no choice. It was a license to print money backed by military power and Saudi oil. That is the system you have lived your entire financial life inside of. That is the system that is now ending. And the reason nobody told you about it is because the people who benefited from it, the banks, the government, the financial establishment, had every incentive to keep you ignorant and compliant while they operated within it for their own benefit. That ends today, at least for you. Now let me explain to you precisely why the system is fracturing. And I want to give you the cold mathematical chain reaction that flows from that fracture directly into your brokerage account. Because this is not abstract geopolitics, this is your money. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing coalition of additional countries are actively constructing trade frameworks that bypass the US dollar entirely. Russia and China are settling energy transactions in yuan and rubles. India is buying Russian oil in rupees. Saudi Arabia, the very nation whose 1974 agreement created the petrodollar, has publicly acknowledged accepting Chinese yuan as payment for oil shipments. Let me repeat that for you, because I want the full weight of it to land properly. Saudi Arabia, the cornerstone of the entire petrodollar architecture, is accepting yuan for oil. The foundation stone has cracked. Furthermore, the United States government, in its infinite geopolitical wisdom, chose to weaponize the dollar through sanctions regimes against Russia, Iran, and others. What that did, and I want you to understand this, was entirely predictable to anyone with a functioning brain and a knowledge of history, was to demonstrate to every other nation on earth that holding dollar reserves and operating within the dollar system meant being subject to potential financial exclusion at Washington's political discretion. You do not need to be hostile to America to find that terrifying. You just need to be rational. And rational nations have been quietly, methodically building alternative settlement systems ever since. Here is the mathematical consequence. When global demand for US Treasury bonds falls because countries no longer need to hold as many dollars, because they are no longer buying oil exclusively in dollars, the price of those bonds falls. Bond prices and interest rates move in opposite directions. This is not an opinion. This is arithmetic. When bond prices fall, interest rates rise. When interest rates rise, the present value of every future corporate earnings stream falls, and therefore stock valuations fall. We are not talking about a 10% correction. We are talking about the potential systematic repricing of an entire asset class built on 50 years of artificially suppressed interest rates. If you are in long-duration Treasury bonds, and you may be without even knowing it, through target date funds in your 401 kilobits, you are holding an instrument whose entire value proposition rests on a system that is actively dissolving. And if you are in growth stocks with high-priced earnings, multiples that only make mathematical sense at low interest rates, you need to understand that those valuations are extraordinarily vulnerable to a sustained rise in the risk-free rate. This is not complicated. This is not conspiratorial. This is the straightforward mechanical consequence of a 50-year monetary system losing its structural foundations, and most investors are going to be blindsided by it because they were never taught to see the plumbing underneath the market. They invest in... Now let me tell you where the intelligent money is already positioning, because while the financial media is keeping you distracted with daily market noise, the institutional capital that actually moves markets is making significant, deliberate, multi-year bets on a specific geographic and sectoral thesis. That thesis is called reshoring, and it is the most important structural investment theme of the next decade. The United States is executing a strategic withdrawal from its role as a global policeman, the guarantor of international trade routes and multilateral institutions that it largely built and funded since 1945. What it is replacing that role with is something far more commercially self-interested, a regional gatekeeper model focused on the Western Hemisphere. And I want you to understand why this is actually a rational strategic pivot, because understanding the logic is what allows you to anticipate the capital flows that follow from it. America is now the largest oil exporter in the world. Read that sentence again. The United States of America has surpassed Saudi Arabia as the world's leading oil exporter. That is not a footnote. That is a tectonic geopolitical fact that reshapes every assumption about why America needed to spend trillions policing the Middle East for the last 40 years. When you are the largest oil exporter, you do not need to station carrier groups in the Persian Gulf to protect your energy supply. You are the energy supply. What you need to do instead is secure your hemisphere, lock down your near abroad, and make sure that the commodity-rich nations in your geographic backyard are commercially integrated with your industrial base rather than with your adversaries. That is the play that is being executed right now, and Venezuela is Exhibit A. The political opening in Venezuela, a nation sitting atop the world's largest proven oil reserves, and specifically a grade of heavy crude that is precisely calibrated for the refinery infrastructure along the U.S. Gulf Coast. For is not a humanitarian project. It is a commercial and strategic masterpiece. The U.S. Gulf Coast refineries were literally built to process Venezuelan heavy crude. When that supply chain reconnects, it creates an energy self-sufficiency for the United States that makes the Middle East largely irrelevant to American strategic interests. The investment implications of that single fact are enormous for energy companies, for petrochemical infrastructure, for pipeline operators, for Gulf Coast industrial real estate. The capital that chases those opportunities over the next 5 years is going to generate extraordinary returns for early positioned investors. The question is whether you are going to be one of them or whether you are going to read about it in a newspaper 3 years from now and wonder why nobody told you. The reshoring of manufacturing supply chains from Asia to the Americas is a parallel and equally powerful theme. Mexico's manufacturing sector is experiencing a structural boom driven by nearshoring demand from U.S. companies that no longer want their supply chains running through geopolitically unstable trans-Pacific routes. Panama, with its canal infrastructure, becomes a more critical node in global trade with every passing month of U.S.-China. Friction, Caribbean Basin, logistics, energy, and industrial infrastructure are in the early stages of a multi-decade build-out. The companies positioned along these supply chain corridors, construction firms, infrastructure contractors, logistics operators, industrial real estate developers are sitting at the beginning of a CapEx cycle that could last a generation. Now, I want to talk to you about Cuba, because this is a story that the financial press has almost entirely ignored, and I believe it represents one of the most asymmetric resource opportunities on the planet right now. Cuba is 90 miles from the coast of Florida. It is an island that, due to 50 years of communist economic mismanagement combined with American sanctions, sits on top of one of the most extraordinary concentrations of critical mineral wealth in the Western Hemisphere, wealth that is almost entirely undeveloped and underexploited. Let me give you the numbers, because numbers are what matter. Cuba is the 5th largest cobalt reserve in the world. Cuba has enormous nickel deposits. It has historically been one of the top global nickel producers when its mines have been adequately capitalized and managed, which under the current regime they have not been. Cuba has copper. Cuba has rare earth elements. Cuba has gold and silver. These are not marginal deposits or speculative geological surveys. These are established, documented, world-class mineral reserves sitting idle because the political and economic system governing the island has been structurally incapable of attracting the capital investment required to develop them at scale. Now look at what is happening geopolitically. The United States has systematically cut off the 2 primary lifelines of the Cuban regime. Venezuela, which was supplying Cuba with subsidized oil in exchange for Cuban doctors and military advisors, has been brought into the American economic orbit through the political transition I described earlier. That energy subsidy to Cuba is gone. Iran, which was providing financial support and acting as a diplomatic partner for Havana, has been subject to intensifying maximum pressure economic warfare that has dramatically reduced its capacity to support client states. Cuba, in short, has been economically strangled from 2 directions simultaneously. That is not an accident. That is a deliberate strategic sequencing designed to create the conditions for a political transition. Now ask yourself what happens when that transition occurs. Who builds the ports? Who develops the mines? Who constructs the energy infrastructure? Who finances the industrial development of an island? 90 miles from Miami with world-class mineral reserves, deep water port access, an educated workforce, and proximity to the largest consumer market on earth. The answer is American companies, American capital, and American institutional investors who were positioned before the transition occurred, rather than scrambling to get in after every financial journalist on television is already talking about it. I have seen this movie before. I have seen what happens to early positioned investors when a resource-rich nation reintegrates into the global capital markets. The gains are not marginal. They are not incremental. They're the kind of gains that change the trajectory of a portfolio for a decade. Cobalt, nickel, and rare earth elements are not commodities of the past. They are the foundational inputs for every technology that defines the next 50 years of human civilization. electric vehicle batteries, utility-scale energy storage, defense electronics, drone propulsion systems, semiconductor manufacturing, AI hardware infrastructure. The nation that controls these material inputs controls the technological future. Right now, China dominates the processing and supply chain for most of these critical minerals. The United States is in a desperate race to diversify those supply chains, and Cuba represents the most geographically advantageous and politically accessible solution to that problem in the entire world. If you are not thinking about how to get exposure to this story before it becomes consensus, you are already behind. Let me now give you a specific, actionable framework for what you should be doing with your capital given everything I have just described, because I did not bring you here for 20 minutes of macroeconomic education with no practical application. I'm going to be direct, and some of this is going to be uncomfortable to hear, and I do not care about your comfort. I care about your financial survival. First, if you are heavily allocated to long-duration U.S. Treasury bonds, whether directly or through target date retirement funds, you need to review that exposure immediately. The entire bull case for long-duration treasuries depends on interest, rates declining, which depends on sustained demand for U.S. government debt, which depends on the petrodollar system maintaining its structural integrity. I've just spent the last 15 minutes explaining to you why that structural integrity is compromised. Long bonds in a rising rate environment driven by declining petrodollar demand do not just underperform. They lose significant nominal value. The mathematics are not subtle. When interest rates rise from 3% to 6%, a 30-year Treasury bond loses approximately 40% of its market value. That is not a bear case scenario I am constructing to frighten you. That is basic bond math that any first-year finance student can verify in 10 minutes. If that money is in your retirement account, you need to understand what you actually own. Second, reduce your exposure to dollar-denominated cash as a long-term store of value. This is counterintuitive for people who have been taught that cash is safe. But cash is only safe if the purchasing power of the currency it is denominated in is stable. The dollar losing its petrodollar premium means the structural support for its value is eroding. Inflation is not a temporary phenomenon to be managed by a few rate hikes and then forgotten. It is the inevitable consequence of a reserve currency losing its artificial demand premium. And it falls hardest on people who hold their wealth in cash, fixed pensions, and fixed rate instruments. These people are not being robbed at gunpoint. They are being robbed through the quiet, invisible mechanism of currency debasement, and it is completely legal. Third, move into hard assets with real-world utility and scarcity. Gold has been the definitive hard asset for 5,000 years, and there is a reason that central banks, including those of China, Russia, India, Poland, Turkey, and dozens of others, have been buying gold at a record pace for the last 3 years. They are not doing this because they misunderstood the gold market. They are doing this because they understand that when fiat currency systems come under structural stress, gold preserves purchasing power across the transition. Beyond gold, look at silver, which has both monetary and industrial demand. Look at the strategic metals, cobalt, nickel, copper, lithium, which are essential inputs for the technological infrastructure of the next half century. Mining companies with exposure to Caribbean and Latin American deposits represent early stage positioning on a thesis that institutional capital is just beginning to price. Infrastructure and construction companies with Western Hemisphere project pipelines represent multi-year earnings growth, driven by a reshoring capex cycle that has barely started. Service companies to the mining and energy sectors in the Americas represent a leverage play on the same theme with potentially lower geological risk. These are not stock tips. These are sector categories derived from a macro framework, and the specific company selection within these categories requires the kind of rigorous financial analysis, cash flow modeling, balance sheet stress testing, management, track record evaluation, competitive positioning assessment that I'm not going to compress into a YouTube video, and that you should not attempt without understanding the underlying analytical methodology. But the directional thesis is clear, and positioning yourself in the right sectors before the consensus arrives is how generational wealth is built. The mathematical reality is this. In inflationary environments driven by currency debasement, asset prices do not just hold their value. They appreciate in nominal terms at rates that can dramatically exceed the rate of currency depreciation, producing real wealth gains for asset owners while simultaneously destroying the real wealth of people who hold dollar-denominated fixed instruments. This is not a theory. This played out in the 1970s. It played out in every significant currency crisis of the 20th century. It is the consistent, repeatable, historically documented outcome of the process that is now underway. The people who own the right assets during this transition will look back on this period as one of the greatest wealth-building windows of their financial lives. The people who stayed in cash and long bonds because they felt safe will look back on it as the decade that quietly destroyed their retirement. I want to leave you with something that cuts through everything I have said today and reduces it to its absolute essence, because at the end of 25 minutes of analysis, there's really only one decision standing in front of you. You now know what the petrodollar is. You now know why it is ending. You now know the mathematical chain reaction that flows from its decline into stock valuations, bond prices, and the purchasing power of your savings. You now know about Venezuela, about Cuba, about the reshoring of the Western Hemisphere, about the critical mineral race that will define the next 50 years of technological civilization. You have been handed for free the macro framework that guides the capital allocation decisions of sophisticated institutional investors. What you do with that information is entirely your choice, and the market does not care which choice you make. The wealth transfer I have described to you today is not going to pause and wait for you to feel ready. It is not going to send you a polite notification when the optimal entry points arrive. It is happening right now, at this moment, in real time, in the capital flows of markets that operate 24 hours a day. The people who are positioned correctly are going to accumulate wealth at a pace that most salary-dependent, cash-holding, long bond-owning Americans will find incomprehensible in retrospect. The people who are not positioned will shake their heads and wonder how it happened to them. I have shown you the door. Walking through it is your job. Subscribe to this channel, share this video with someone whose financial future you actually care about, and start doing the work. Because in the market that is coming, ignorance is not just uncomfortable, it is expensive.